The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The bond market continues to be the tail wagging the dog. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. Stocks are in the green again before Alphabet kicks off earnings for 5 of the Mag 7 names. Not participating in the rally today are home builders. The group is down almost 5% after D.R. Horton posted weaker than expected orders. But the real action, as Romaine mentioned, is in the bond market. The 10-year yield rose as high as 4.33%. That is the highest since July. But a decent 7-year note auction today improved the tone overall, and now we're pretty much little changed. Bitcoin surpassing $73,000, record high. Of course, it is part of that Trump trade that has really taken over. Romaine?
Yeah, and that is a big topic of conversation. In fact, the parlor game on Wall Street as of late really is trying to divine an explanation for why Treasury yields continue to rise. Benchmark 10-year yields, which hit a 52-week low just last month, have up about 70 basis points in the 6 weeks since. And while bets on election directions are certainly at play, a more substantive explanation that can actually be found in Citi's Economic Surprise Index, which flipped from negative to positive at the start of the month and now, right now, sits at its highest since April. Now, those economic surprises might also explain the recent turnaround in consumer confidence. University of Michigan data released last week showed consumer sentiment at 6-month highs. Fresh data out today showing the Conference Board's gauge of overall confidence now at its highest level since the start of the year. And a measure of expectations for the next 6 months, that's at the highest since 2021. Now, we're going to see if that confidence and those smiles remain as we work our way through this earnings season. An earnings season shifting into fourth gear today with several consequential reports after the bell, including Alphabet, Chipotle, EA, DaVita, and AMD, a multi-trillion-dollar cross-section of the market, Scarlett, and a multi-billion-dollar cross-section of the economy.
And we'll be breaking down all those earnings as they cross later on today. But for now, the bond market is really hogging the spotlight. Treasuries on track for their worst month in more than 2 years. Yields on both the 2-year and the 10-year, and that is the white line and the blue line, have climbed some 50 basis points in October alone. So what's driving this off? Clearly a number of things, but just like the election, it's the economy, stupid. Data is coming in better than expected, as reflected in the Citi Economic Surprise Index that Romaine mentioned. That is the yellow line in this bottom panel here. But we know that this tends to be self-correcting because economists eventually catch up, they adjust their forecasts higher, and that pushes the index back to a more neutral level and dilutes that narrative that the economy keeps surprising to the upside.
All right, well said here as we kick you off to the close here on this Tuesday afternoon. We keep this conversation going about the moves that we've been seeing in the fixed income space. Vishal Khanduja joining us right now, head of broad markets fixed income at Morgan Stanley Investment Management. All right, Vishal, let's just get to it. I mean, here, it seems like the economic tea leaves seems to be a much bigger driver of what we've seen in yields over the past few weeks, particularly coming out of a Fed meeting where we all thought yields were on a straight shot down.
Absolutely, yes. Good afternoon. Thanks for having me on. We were very vocal from our positioning with our clients in our client meetings that the Fed will underdeliver post that 250 basis points of cuts that we had priced in. From our perspective, those were recessionary level cuts. And from the Fed's speak, as well as from our assessment, we needed recalibration cuts from very restrictive to less restrictive policy. Around these levels, I think that's where we think fair value sets in for yields. We saw that a little glimpse of it today in that 7-year auction. I think Scarlett mentioned it right at the top of the hour as well. Dealers taking half of usual of their uptake in that auction, which the end investors showing up. Around these 2% real yield levels is where we think that the demand actually for a fair value for investors starts to show up in nominal yields as well.
I am curious, Vishal, why we haven't seen a bit more of an embrace of longer duration. It still seems like a huge portion of the street right now is still overweight, shorter duration fixed income. Why?
I think I can try to, tell you the steepener, a trade that is sort of in a lot of scenarios could work really well for fixed income investors, where you're overweight the 0 to 10, 0 to 7, however you want to define it, and less weight or underweight the back end 10-year and out. I think the deficit situation has started to become much more of a concern. I think the IMF came out with a paper and a dashboard where the U.S. basically had the last spot in fiscal concerns when you look at the developed market globally. With the amount of debt we have outstanding, the amount of liabilities that are coming due, and yes, with the uncertain political environment that we'll get into in the first 2 quarters of next year. So I think that back end of the curve, which is less affected by the Federal Reserve's current moves, more affected by other scenarios as well, the amount of debt, deficits, et cetera, for a country.
Sure.
That's where I think we are underweight, and that's where the market is underweight as well.
Vishal, are bonds oversold at this point? And if so, where on the curve are they oversold?
5 to 7 year point, I think, is fantastic spots right now for adding duration. Overall, we think these are fair values. Can we overshoot? Absolutely, yes, depending on the election results next week. But I think before we get there, I think we have a little noisy payroll report to get to, and then I think the Fed information that will come to us right after the election outcome from that part. Not only that, a lot of economic data as well.
Absolutely. And speaking of noise, we have the Treasury set to announce debt sales on Wednesdays. Do you expect any surprises given how the price action has evolved this week?
Not really. I think at this point it is absolutely in their and the market's best interest to avoid any kind of surprises that could come through, that could be perceived that there was a surprise for various reasons, etc. So I think a status quo of the coupon supply, status quo of how much portion of Treasury bills versus the overall debt that needs to be refinanced, etc. So I think it'll be a meeting that they would love to have no surprises out of. At this point.
When we talk about portfolio allocation, specifically in the fixed income space, obviously a lot of focus, of course, on treasuries. We've seen a lot of reallocations in the corporate space, particularly with a slightly lower rated corporate bonds, not necessarily junk, but certainly at the lower end of investment grade. Are you in that camp here that it is relatively safe enough to start embracing something a little bit further down the credit curve?
Yes, I think from a fundamental aspect, Romain, we feel pretty convinced of a soft landing. I think that's the term that we've used. And I know it's a pretty well-used term across our asset manager space at this point. But I think the way we've expressed it, it's much more of those picking our spots where valuations are commensurate to that fundamental view. And a lot of the parts of the corporate bond market at this point, I would say on a spread basis, I think it is overpricing some of that soft landing scenario, almost getting ahead of itself in certain parts. And some of the BBB, some of the financials, I think those are the spots that we're still finding quite a bit of value. And then securitized credit, I think that has been our sort of go-to spot at this point, both from a fundamentals as well as from a valuation perspective for the next 12 months.
All right, I have to ask you about the election, which is just 1 week away. Obviously, a lot of folks are going to be up all night and probably over the next couple of days following that election, looking at their portfolios, looking at their models, looking at their spreadsheets. Are you anticipating any significant changes in policy, depending on, it doesn't matter which candidate we're talking about, but whoever's elected, are you anticipating any significant change in policy that will have a meaningful impact on your allocations?
Not significant from the time of when the campaign started off for both the candidates. And we've seen both these candidates, both these parties be very vocal, even in their previous term for the Republican side and the current term for the Democratic side. I think the makeup of the House and the Senate is going to be very definitively deciding what our portfolio allocations look like when we get into 2025 from that on. So I think that having that divided sort of makeup there would be paramount for a lot more sort of fiscally conservative sort of decisions coming out, a lot more economically sensitive decisions coming out of the administration, rather than one side taking it all. So I think those are the things that we are looking for at this point.
All right, Vishal, going to have to leave it there. Vishal Khanduja, head of broad markets fixed income at Morgan Stanley Investment Management, kicking us off to the close here on this Tuesday afternoon. A lot to cover here on the program, including a slew of earnings after the bell, a better picture on whether the Magnificent Seven are indeed still magnificent. 5 are set to report this week, including one of the trillionaires, Alphabet, out after the bell tonight.
Plus, more bad news building up for the home builders as industry bellwether D.R. Horton raises major concerns about deterring potential home buyers.
All right, and synchronize your watches. 7 days away from the 2024 U.S. elections that will decide the presidency as well as the complexion of the House and the Senate. Isaac Boltansky, Director of Policy Research at BTIG, is going to be joining us in just a bit here to talk about what we're seeing in the polls. All that and more coming up in a bit. This is The Close on Bloomberg.
A busy week of tech earnings gets going in the next hour with Alphabet and Reddit reporting results after the bell, followed by Meta tomorrow. Don't forget, we also have AMD as well. Joining us now to break it all down is Mandeep Singh of Bloomberg Intelligence. And it feels like among the Mag 7 names, 5 of them will be reporting this week. Alphabet, its stock is down about 8% since its last earnings report. And so there's a lot of talk about how its valuation is really low. And as a result, it's got a fairly low bar to clear for these results.
Yeah, I would agree. I think the expectation is for 13% top line growth when you compare it to Meta at 20% and Microsoft at 15%. So it's baked in terms of their growth. And look, they have guided that YouTube plus cloud is going to be a $100 billion ARR business by the end of the year. So that diversification element is playing out, even if there is, some headwind on search from ChatGPT and Perplexity and whatnot. The other businesses are humming, and that's not factored in the guidance, I think.
Headwinds on search, not just from competition, but also from what the government could do, and we don't have any kind of timeline for that.
Yeah, that, I think, is a wild card in terms of what could happen, whether it'll be a forced divestiture, what's the timeline. So, look, I think that has slowed them down in terms of, shipping more products or being aggressive in terms of competing with the likes of ChatGPT. But I think right now they are catching up. Their LLMs at par with ChatGPT and Meta. And to my mind, if they can control the cost, that's the big focus this quarter. Are you going to see margin degradation? And whichever of the Mag 7 says CapEx is going up and their margins are trending down, I don't think the reaction will be very positive.
So when we talk about the balance, particularly with the companies chasing AI, we're showing Alphabet on the screen there, talking about Meta, and obviously AMD is sandwiched in there here. That AI trade overall, writ large, is that still intact?
Absolutely. I mean, the market is fixated on who benefits from the compute spend. So all these companies are raising their CapEx, but also who can monetize it in the best way. And Alphabet has deployed Gen AI in their core search. Now you see AI overviews at the top, and they are showing you ads as well. So anybody who says ad model is not applicable to generative AI, Alphabet is doing it with Gen AI overviews and doing it successfully.
I'm going to put you on the spot.
Yeah.
If you're looking at these companies that are reporting, that are in the AI space predominantly, so Alphabet, Microsoft, Alphabet, AMD, we'll throw in there as well. What's going to be the most important one to watch this week?
I mean, clearly Microsoft is the poster child when it comes to their OpenAI partnership. But the problem is the bar is much higher for them. Azure growth better be above 33%. Because anything below that, it's like a disappointment. Even though 30% on an $80 billion run rate is a great growth. But still, I think for Microsoft, the bar is high. I think they have to beat that. And for Alphabet, that's why expectations are low. And cloud and YouTube, these are the businesses that they told us are doing very well. So I think core search, if they can dispel the fears, there will be a positive reaction.
How does Meta fit in here? Because you mentioned competition from different other companies, including Meta, which is trying to build out its own AI search engine. And the company has done very well in the last couple of earnings reports.
Yeah, and now they have a product to show with the Reality Labs investment, the AR glasses. But still, look, Meta is still an ad-dominated company. They don't have that diversification element. And the bar keeps getting higher. 20% growth rate when your comps get tougher. Like, how much can you beat and raise? Maybe they surprise us because they're executing very well, but that's where, because it's so dominated by ads, it's hard to find that lift in the earnings.
All right, Mandeep Singh, the best of Bloomberg Intelligence. A nice preview here of some of the big tech earnings that we're getting this week. That includes names like Meta, Microsoft, as well as AMD and Alphabet coming down the pike later after the bell tonight. Meanwhile, staying in the space of AI, a few headlines, including on valuations over at Elon Musk artificial intelligence startup XAI, Scarlet Fu. How much would you value this at?
I mean, I don't know if I knew.
All right, well, a new funding round is going to value at roughly $40 billion, according to a person familiar with the situation, and then a separate financing coming in at $6 billion. So a company that basically didn't even exist in more or less a couple of years ago, now sitting on potentially as much as a $50 billion valuation.
I'm guessing that that'll be part of the AI business that does well, because Elon Musk made some comments at the Future Investment Initiative in Saudi Arabia. You heard what he said, right? About how, some of the AI will work out pretty well, others not so much. And he actually quantified it.
Yeah, well, he said 10 to 20%, I mean, which is not really a call or anything.
It's just like stick your finger in the
I mean, anybody can say, you can say that about any product. I mean, I'm sure when they came out with Play-Doh, 70 years ago, somebody said, there's about a 10 to 20% chance kids are just going to eat this.
Maybe, but a lot of people pay attention to them for better or for worse.
All right, let's pay attention to what's going on over at McDonald's. A red day for the Golden Arches. We're going to get the latest results out of McDonald's as it struggles with same-store sales overseas, as well as that recent E. coli outbreak. That conversation coming up next, right here on The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we're going to start off today with Six Flags. Guggenheim starting coverage with a buy rating and a $52 price target. The analyst lauding the Six Flags portfolio of 27 amusement parks, 15 water parks, and 9 resorts. Also highlighting the relative entertainment bargain of regional theme parks. He says management has multiple growth levers and positive catalysts ahead, which includes attendance growing back to historical levels. Six Flags shares up 1% on the day. Next up, Trade Desk, the advertising tech company cut to sell over at New Street Research. The analyst noting that Trade Desk has benefited from the current election cycle, but it faces limited upsides in 2025, a trend the analyst says doesn't justify current valuations. Investors, at least for today, disagree. Those shares higher by 2%. Finally, let's take a look at Tapestry. The luxury retailer cut to hold over at TD Cowen. This comes after that rally in the shares following a federal judge's decision to block Tapestry's acquisition of Capri Holdings. The analyst also cites worsening trends in China and tough multi-year comparisons for Tapestry's Coach business. Those shares down 3.5% on the day, and those are some of our top calls. Let's turn now from luxury brands to other companies that are reeling from weaknesses in China. McDonald's. The share is slightly lower here on the day after its third quarter report came out. Same-store sales much lower than expected, largely because of a slump in international markets like China and the Middle East. And while the disruptions from the recent E. coli scare weren't reflected in the most recent results, analysts, they were certainly eager to hear commentary from the company about how it's handling the situation. Jon Tower is equity research analyst over at Citi. He's got a neutral rating on the shares, which he's had since he picked up coverage a couple years ago when he joined Citi. Jon, great to having you here on the program. Let's start off first with the same-store sales numbers. We were expecting weakness, and we got them. Was the makeup of that weakness on a regional basis surprising to you?
No, it wasn't. What was encouraging was to see the traction in the U.S. on the traffic side, driven by the move to the $5 meal deal, as well as a couple of LTOs during the period that really helped kind of change the trajectory of traffic and same-store sales in the U.S. The offsetting piece has been the weakness mostly in Europe, but also continuing across a lot of the Asian markets. China's one, for example, and the Middle East. So the complexion of it didn't necessarily look any different than what we were anticipating. The magnitude, particularly on the IOM segment, was where we were a bit more surprised to the downside.
Yeah, well, is there a way that they can, sort of arrest that decline that we're seeing over there? Because there is a sense here that is still a big component of the broader McDonald's growth story, at least for investors, if you will.
Yeah, so when you think about Europe, in particular, the IOM segment, which is primarily Europe, Canada, and Australia, they've worked to try and improve their value imaging in that market, right? They've introduced everyday value meals across a handful of different markets where they didn't have it before. They pulsed value more on media than they've had before. They've had more a la carte options. But, I think they're just dealing with the fact that the consumer in those markets is much weaker than what we even have here in the United States. And they're fighting tooth and nail to win those consumers, get them off the couch and going, to the restaurants rather than picking up stuff from the grocery store in order to kind of drive their sales. It's not necessarily resonating quite yet. They did say that they're gaining share, but unfortunately, the magnitude of the declines in the market are just overwhelming them at the moment.
I mean, whether it's in the U.S. or overseas, do you think McDonald's has backed itself into a corner where it needs to keep offering these value meals in order to maintain foot traffic?
Yeah, they do. Right now, where the consumer is globally, yes, they need to continue to pulse value and win. That said, they have seen some relative success with kind of a barbell approach, right? Where you've got this $5 meal deal on the one hand in the US, but then you have things like Chicken Big Mac, which is more premium price point coming through. And they did have a couple of collectible options during the quarter. I wouldn't be surprised if we see more of this stuff coming, maybe fourth quarter, probably more beyond that into 2025 to help kind of drive that traffic and the check to preserve it. But, importantly, this is core to McDonald's. The idea of value, the idea of delivering, affordability to the guests in a convenient fashion. Right. That's McDonald's core, so they should win here over time.
Yeah, so it's very much on brand for them. I get it. Jon, what would turn McDonald's into a buy for you? Romain mentioned that you've had a neutral on the company ever since you began coverage. What would make you more optimistic and actually upgrade it to a buy?
Yeah, look, I think we'd have to have greater visibility into not only the same-store sales trajectory in the U.S. improving consistently, as well as in IOM, but we'd also like to see the profitability improve, right? That was one of the knocks on this quarter was, they saw some traction in the U.S., but their store-level margins were down, and year-to-date store profits are down about 8% in the U.S. from the company side. Now, obviously, that's not the franchise side. They're a highly franchised business model, so it's more about the aggregate sales growth than it is necessarily about the company store margins and profitability there. However, it's likely a decent indicator for the direction that franchisee profitability is going. So you want to see that trend in the proper direction, which is up, in order to get more excited about it. And I think once we see that happen, there's an argument to be made for us to get more constructive.
All right, got it. Thank you so much. Jon Tower over at Citi with
Thanks,
a neutral rating, a hold rating on McDonald's in our top calls today. And speaking of the sell side, Romain, did you see that JP Morgan has reclaimed the top spot among sell side firms in a survey? It was the number one firm for a while, but it actually gave up that crown last year to Bank of America.
Yeah, now Bank of America ceding that crown here. And I mean, it's kind of interesting. I mean, we talk about the horse race between these companies. I mean, a lot of these analysts really pay attention to those.
Absolutely.
Because they, plays a big factor in there
right?
here. And it's this idea here, too, though, this idea of how much the top line of the company cares and how much the actual individual analysts care too. But as we know, we talk to these analysts all the time, and they love to tout that, I was number one this year or number two that year, blah, blah, blah.
It's all about bragging rights and, putting it on your resume. All right, coming up, some key data for the U.S. labor market coming out this week. We had JOLTS, the September print today. We're going to break things down with Jennifer Lee, the senior economist at BMO Capital Markets. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostic.
And I'm Scarlett Fu. And Romain, I feel like we should talk about the stock market, given that it's rising yet again. But the real action remains in the bond market, where, interestingly, it's not doing anything right now, though the steady move up in yields has captured everyone's attention.
Well, what's actually kind of intriguing is, though, that steady move up in yields is now flipped to the opposite end. And it gives you some idea here of the kind of just the monster volatility that we've been seeing in the fixed income space here. As you pointed out, at one point on benchmark treasuries, we were up 3 or 4 basis points on the day. We're now down just basically about 1 basis point, but it gives you that oscillation here between directionality, the idea that no one really seems to know which direction a yield should be going.
Although the direction has been up, and there's a lot of questions about whether it reflects the strengthening economy or maybe part of the Trump trade overall, or maybe it's a combination of both.
Yeah.
All right, well, in terms of data that did come out today, we had today's September JOLTS data, which showed diverging paths in the U.S. labor market. You had job openings falling to 7.4 million. That is the lowest since early 2021. Meanwhile, September layoffs picked up to 1.8 million, further highlighting a slowdown in the the labor market. And of course, all of this comes ahead of the government's October jobs report, which will be a key indicator for the central bank. Joining us now for more on the labor market is Jennifer Lee, Senior Economist and Managing Director at BMO Capital Markets. Jennifer, I know there's a temptation to read a lot into the JOLT survey and the Challenger job reports and ADP the week of the jobs report. But I'm curious whether this is a credible report for us to kind of pin our hopes to, because the JOLT survey represents only 0.6% of establishments, and the survey response rate is fairly low, I think 1 in 3.
Yes. So first of all, good afternoon, and thank you very much for having me on. This is going to be a very interesting week, as you pointed out, for jobs. Anyone who's reading the tea leaves on the jobs market, but at the same time, it's going to be a very, very messy time period, for financial markets ahead of the election, of course. But I'm just very worried about how this payroll report is going to pan out on Friday. There's so much noise going on. We've got all the storms, all the hurricanes with Helene and Milton, and of course the Boeing strike might be factoring in, as well as that 3-day East Coast port workers strike might have an impact as well. So we cannot read too much into the headline, if anything, and it'd be interesting to see what the revisions say as well. But certainly this morning's jobs reports were a little bit mixed. It was a little bit for everything. You mentioned the job openings declining, quits rates fell as well, which is good. Fewer people walking away from the job, which is good news because it means that there's less pressure on wages. And of course, there's also more hiring going on. So all of that still points to a pretty steady, decent job market. At the same time, we have the Conference Board survey, the Consumer Confidence Index. Aside from the headline jump in confidence, I was more focused on the job measures when people ask, who finds jobs hard to get and who finds jobs plentiful these days. And those surveys, responses actually improved for the first time in a number of months, which points to actually resilient job market. So it's a little bit of a mix. So it's very interesting how this is all panning out.
So Jennifer, when we look at the jobs report on Friday, when that comes out, there's going to be a lot of noise. But which part of the report, which data point is likely to be the most clean?
None of the above. I'm gonna have to point to the jobless rate. When it looks at the household survey with the how many people were employed versus the labor force, and then everyone's going to be focusing in, I think, on that number. And just again, given what we saw in today's conference board survey, there's a chance that we could see a third monthly decline in the unemployment rate. Now, both of these surveys do not go hand in hand all the time, but they're kind of close. So it'll be interesting to see. But again, we could see another tick down in the jobless rate. Who knows if it's going to go down below 4%? I'll be a little bit shocked if it does that, but you never know in this environment. But that'll be very telling, I think, and it'll be very interesting to see how the Fed sort of digests this ahead of the next announcement.
So we talk about a resilient labor market, relatively high consumer confidence, so still below pre-pandemic levels. Translate that into consumer spending. We're going to get another update, at least at the quarterly level, and again at the monthly level on some of those personal spending numbers, right. Jennifer. Is the market going to be pleased?
Well, it depends on what you want to see, of course, right? Like obviously, I would like to see a resilient market. We want to see that soft landing play out. We're going to be getting that third quarter GDP number out tomorrow. We're looking for about a 3% annualized increase, which is sort of matching, what we saw in Q2. Will be, I think, more interesting. That's very much of a look in the rearview mirror. I think will be more interesting in what happens, as you pointed out, in the monthly data, the personal income and spending data for September, just to see what the momentum was heading into Q4. And, we'll see how wages fare. And that's, of course, going to be the main driver underpinning consumer confidence and consumer spending.
But I am curious, Jennifer, just in terms of how you and your whole team over there at BMO is looking at the consumer spending side of the equation, because that seems to be where a lot of the angst that we're seeing in this market, the concern here that there are cracks there. They may not be as visible as people want them to be, but there is concern that certain folks aren't spending enough to keep these aggregate numbers higher.
Are they not spending enough because they're worried, or because they're just putting some aside for a rainy day? And I think there is a differentiating factor there. And I think because the job market so far is remaining fairly resilient, again, with just a 4.1% unemployment rate, the fact that wages and salaries up until at least August, have been averaging about 4.5% per month over the last half year or so, which is still pretty decent. We're seeing a roughly 5% savings rate. So it shows that consumers are still in a decent position in the driving spot, the driver's seat, in order to continue to spend, but they're not spending as much as they potentially could be, which isn't a bad thing. As long as they've got some buffer in there to set aside for when things are bad, I think that is, to me, that's a good thing.
You know, when I look at the economic surprise index, the Citi economic surprise index has pretty much been a straight shot up since late August. The low was reached in July. At what point do economists readjust their forecasts higher, and the index starts to recalibrate as a result, changing the whole narrative that the economy is stronger than expected in the process? We should be getting close to that point, right?
Well, we actually just recently upped our growth forecast by 0.2% a couple of weeks ago. Basically, though, the straw that broke our backs was the retail sales report, because it was just pretty much across the board strong, and it just shows that the consumer is still able and at that point willing to spend across almost all categories. So we actually raised our growth forecast, and I think I think everyone's been surprised by how resilient this U.S. economy has been after so many rate hikes, and it's still going strong. I think I actually did check. It's a little humbling, but I checked at the bit to see what our calls were for the beginning of the year for what the U.S. economy was going to fare, and it's basically half of what we're expecting, half of what we have right now. So I don't think we're alone. I think everyone's been very, very surprised by all of this.
Jennifer, when you are, I know you're not pouring through earnings reports the way that the analysts over at BMO are, but when you listen to what the chief executives are saying in response to questions about their end customer demand, what's your big takeaway from the anecdotal that you're hearing?
There is the fact that there is still softness or pockets in spending in those particular companies, I guess. But it wasn't every single company that's reporting softer spending. So it shows that it's again, because it's not consistent, and it depends on which the income level you're at, of course. So I think a lot of this has to do with again, which income levels you're coming from. But again, on the aggregate level, just given what the numbers that we're seeing, broadly speaking, from the GDP reports, from the monthly spending reports, it still shows a resilient U.S. consumer, at least as we're heading into the year, at the end of the year.
All right, Jennifer Lee over at BMO Capital Markets. A closer look. It's the slew of economic data coming down the pike, of course, on the back of that JOLTS data today, a drop in jobs opening. That drumbeat, of course, until we get to that monthly jobs report coming out this Friday. Expected to see a significant drop in the number of jobs created in the month, though huge distortions potentially because of hurricanes and other issues here that kept people at home. When we come back, we're going to take a closer look at some of the big movers on the day, and that includes home builder stocks getting hammered today, and D.R. Horton, one of the biggest decliners. It's our stock of the hour, and it's up next. This is The Close on Bloomberg. All right, let's take a look at shares at D.R. Horton, down about 8%, having the worst day going back to at least January after the builder reported home order and gross margin results for the fourth quarter that disappointed investors. Jess Menton joining us right now, helps to lead our equities coverage here at Bloomberg, and that might be a bit of an understatement. And I want to start off here with some of the comments that we heard on the conference call. And the executive chairman made it very clear that basically potential homeowners, I should say home buyers, are still feeling the pain. And yeah, rates have come down, but they want them to go down even more, and that's pushing things out into 2025.
That's exactly it, and what their executives were saying on the earnings call. So even though we've seen the Federal Reserve obviously cut rates, their benchmark federal funds rate by 50 basis points in September, it's still not enough, especially when you're translating, say like Freddie Mac, if you want to look at where it's trading for the 30-year fixed rate mortgage, that's around 6.5% right now. So even though the 30-year was coming down a little bit in the third quarter, it's already started to creep back up a little bit. And then if you look over at the 15-year, it's a little over 5.5% too. So overall, if you're thinking about a consumer and people, especially because D.R. Horton's for first-time home builders, it's not like a luxury type home builder. So especially those first-time home buyers who are, especially with cost cuts and struggling with those types of things, that's really getting pinched, and they just don't feel it right.
And it wasn't just the rates. I mean, we talked on the call about lending standards as well, and then there's a whole issue that prices for homes themselves haven't actually come down in the same proportionate way relative to rates. I mean, you would think there would have been a little bit more of an inverse relationship.
Right, and then the whole inventory build, I mean, that was a problem even before the pandemic, but obviously got exacerbated in recent years, but that's still been a problem too. So the home prices are rising, and then you still don't have enough inventory too.
When you're talking about first-time home buyers, oftentimes you're renting beforehand, so you're thinking, how much can I actually pay for something? And you reverse engineer it, right? You're like, I can pay up to $5,000 a month. So whatever I get, it has to fit into that little number, right? So if rates change, then that like blows up whatever plan you had to buy X home or Y home. What's the distinction of D.R. Horton versus the other home builders? Like, why is D.R. Horton kind of an indicator for the rest of the sector? Because there's a lot of other home builders that cater to different parts of the market.
Right, like very different if you're like a Toll Brothers or a Lennar, something like that. But like I was mentioning too with D.R. Horton, since it is that first time home building segment too, especially when you're thinking about the economy still holding up pretty strong. I mean, we're going to have another update. Actually, it's the first update for third quarter GDP tomorrow morning from the government, and the Atlanta Fed GDP models came down a little bit when it was updated today, but it's still around 2.8%. So it's pretty strong growth for the third quarter. But when you're thinking about, especially we'll have consumer spending numbers too coming up later this week as well. But when you're looking at that, and especially where people are getting pinched, it's still really hard to try to go out, and especially if you're looking at a 6 handle for a 30-year mortgage, what that means. And even people who wanted to refinance, for instance, like they're waiting for those rates to come down a lot more, not just where they've been. And
it's a confidence game too, right? I mean, we talk about these numbers in kind of this nerdy way, but at the end of the day, it's how people feel and whether they feel comfortable taking on what is effectively, a 30-year commitment for their life.
That is, and then to kind of stare that, especially people who were able to lock in maybe 2 or 2.5% before COVID.
Yeah, those days are not coming back anytime soon. Jess Menton of Bloomberg News, thank you so much. Really appreciate it. When it comes to home buying and home selling, remember there used to be this big thing about the spring selling season? Feels like that doesn't really exist anymore.
No, I think that shit kind of came and went here. A lot more coming up here as we count it down to the closing bells. Lori Calvasina over at RBC Capital. She's on deck. This is The Close on Bloomberg.
I think the makeup of the House and the Senate is going to be very definitively deciding what our portfolio allocations look like when we get into 2025 from that on. So I think that having that divided sort of makeup there would be paramount for a lot more sort of fiscally conservative sort of decisions coming out.
All right, Vishal Khanduja over at Morgan Stanley Investment Management kicking us off to the close just about 50 minutes ago here. Stock's a mixed bag here, kind of a flip-flop of what we saw yesterday, where you had kind of that massive, I guess, somewhat outperformance, if you will, by small caps relative to what we saw in big caps. And that's kind of flipped today with the NASDAQ up more than 1% and everything else just in its wake.
Yeah, as we await Google earnings, or Alphabet earnings, I should say, which kicks things off for the rest of the Mag 7 that we'll be reporting this week. A lot of interesting different groups that are moving a lot. Home builders among them. This group, XHB, actually reached a record high about 1.5 weeks ago, but has since fallen about 8%. And the latest news out of D.R. Horton is certainly not encouraging for anyone who's thinking that home builders will get another lift.
Yeah, and let's stay with earnings too, because I mean, as you just mentioned, we're going to get a lot after the bell. We got quite a few this morning, including from D.R. Horton, as you just said, McDonald's, PayPal, and a few others. And after the bell, of course, we get AMD and Alphabet, basically your big headliners, but quite a few others, including Mondelez, Corvo, as well as Chipotle. Lori Calvasina is the head of U.S. equity strategy over at RBC, and she joins us right now to help count us down to the closing bells. And Lori, I do want to start off with earnings here, mainly because I took a look at your recent note that you put out at the end of last week, and you call it a relatively disappointing earnings season. And I know we're still relatively early in that season, but what did you find most disappointing about it?
So, well, you hit the nail on the head, Romaine. It is still early. We're getting deluged this week, and I was very clear with people yesterday saying, look, these stats could all change. Last week was very industrial heavy. As my team and I went through the transcripts, and we have a whole system in place. I won't bore you with the details, but as I was going through everything on Friday that they had collected for me during the week, and I was just really, looking at the commentary on the outlook, it was mixed. I was hearing a lot of the same themes that I've been hearing in prior reporting seasons, but it felt like maybe there was a little bit more emphasis on the negative. We also got a boatload of comments on the election, more so than what I've really been seeing when we've been looking at earnings in recent weeks, and in the last reporting season, and just time and time again, just companies hitting us with the uncertainty aspect and how that's restraining business activity. And then the interest rate commentary was also pretty mixed. So on the one hand, we had some companies coming in and saying, look, we're excited, we're optimistic about rates coming down.
Yeah.
And then we had other companies that were really just dwelling on the negative impacts of the high rates that are still in place. It wasn't terrible.
Yeah.
It wasn't great.
But given the industrial nature of those companies, and let's just sort of say, those are definitely companies more rooted in the traditional economy. Do you think that the narrative, or at least the language that we hear from some of the big tech companies, which in the minds of a lot of investors, they think are insulated from some of the issues that might be plaguing, say, the industrial companies, do you think that narrative is going to be different?
So I think that it could be. I think we have to see what we get. I think we're going to get more color on the consumer this week, and that seemed to be lacking last week. If I go back to, kind of week one, and I realize these things are all trickling out anyway every week, but if I think back to kind of that financials heavy week, I actually exited that week feeling pretty good. I think the financials give us a good view into the plumbing of the economy, the health of the consumer, and we felt pretty good coming out of that based on the commentary we were hearing there. I think when you look at the technology companies, it's a slightly different setup. So on the one hand, we have seen very strong earnings revisions for that sector coming into this reporting season. They're not wild off to the races, but it's been in good upward revision territory. But we have had a bit of a valuation problem there. Those valuations have come back down to earth on a relative basis against the broader market. We're sort of seeing things starting to trend more closely to neutral as opposed to 2 standard deviations above the long-term average, which is where we were last year. But there's not. It's not like we've got a super cheap sector. So I do think the commentary needs to be good coming out of there to really sort of keep that area going strong.
Bank of America noticed that CEOs mentioned the word bottom in their quarterly results quite a number of times. In fact, it was up 56% versus the same time last year. And they've noticed that in the past, this tends to precede a broad improvement in earnings. I'm curious whether, as restrained as the commentary might have been from industrial companies or whichever companies you were going through, did you get the sense that things are at least approaching an inflection point?
I did notice some companies, identifying with that idea that, certain end markets they felt like were at a bottom. But I think I also noticed equally, sort of this, it's early days. So we heard that on China. It's early days seemed to be sort of the comment on the interest rate story. And even in the discussion of inflation, right, we've heard companies, last few quarters saying the cumulative impact of high rates and inflation have been weighing on business activity and consumer behavior. And, the inflation commentary was kind of mixed. I mean, we were still seeing some companies complain about the onset of high prices. So, when I think back to some of the other studies we've done, Scarlett, we've looked at things like trends in recession commentary, trends in labor. We are seeing, certain, indicators, right? Uncertainty is high, but talk of recession is pretty low. So there are definitely some complex cross currents here.
Fair enough. You mentioned the election and how the commentary has really fixated on the election as well. You've, of course, had your own discussions with clients about the election, and you notice a big split between those who are based outside the U.S. and those who are inside the U.S. Those who are inside the U.S. only discuss it as a matter of necessity and kind of just can't wait to get past it at this point.
Yeah, and that's, I would say that's generally been the description I would give throughout the year, right? We've discussed it as staring at the sun. If you talk to your typical U.S.-based investor, they have to have the conversation because they're getting questions, but it's pretty painful, and they try to look away as quickly as possible. I will say over the last couple of weeks, when I think about sort of my meetings with U.S.-based investors, we have been talking about it a lot more. It's been coming up earlier in the conversations. So I think we're just getting so close to the event that they're more willing to engage. That being said, I don't think they're doing a whole lot, Scarlett, and I'm not complaining about that at all. I think that's the smart move and the right thing to do. But I think, generally my U.S. long onlys, they feel confused about what the outcome is going to be. They're not entirely sure we have a great playbook for what you do in the different outcome scenarios, and they are talking. But I don't get the impression that they're trading a lot on it. I think they're trading on earnings right now.
All right, Lori, great stuff. Got to leave it there. Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets, helping us count you down to these closing bells. Those bells now just about 2.5 minutes away here. A mixed day here with the Dow in the red, as are most of the industrial stocks here. But you are seeing a little bit of a perk right now in those big cap names, including the NASDAQ 100 up 1%.
Yeah, as Alphabet gets ready to report just shortly after the closing bell, Electronic Arts will also be reporting an AMD, which of course is very interesting given that it's kind of a secondary play to NVIDIA.
Yeah, and I don't know why. She wears leather jackets just like Jensen Huang, but she's not the rock star that Jensen is for some reason. I don't know. I mean, she just took a tiny little company and turned it into a behemoth. But, hey, who's counting? Anyway, we are counting, actually, and counting you down to the closing bells. Our full market coverage, it starts right here, right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here alongside Scarlet Fu, taking you through the closing bell, a global simulcast. It starts right now. Carol Massar and Tim Stenovic joining us from their radio booth as we welcome our audiences across all of our Bloomberg platforms.
We call it our radio palace.
The palace. It's a very nice palace booth.
Yes.
There. That's, really? You call it a palace?
Yeah, we do.
Okay. Well, it looks
really
nice from the outside looking in.
Shrine.
It's a shrine. All right, let's get right to it, guys. We got a lot to get to here the after hours here as we wait for the closing bells. Carol, it's been quite a day here on Wall Street.
Yeah, very interesting, right? We're just kind of coming off our best levels of the session, but I've been thinking about a name like Alphabet that reports after the closing one, obviously a key focal point for us. This one's been up as much as 2% in today's session, just kind of pulling off of that, but still a 1.8% gain ahead of its results. We'll see whether or not it delivers.
I have a question, Tim.
Yeah.
If that's the palace, who's the ruler? You were Carol.
We're a democracy.
It's co-crowns.
Yeah, we're a democracy.
We're co-crowning.
That's not a thing, but okay.
It is now.
You mentioned shares of Alphabet. Helping to push the NASDAQ composite. I know we really care about the NASDAQ 100, but the NASDAQ composite poised to close at a record today. Scarlett.
Yeah, so we'll watch for that. And of course, Alphabet will kind of set the tone for the rest of the Mag 7 names that will be reporting this week. The other thing, of course, is the action in the bond market, which has been kind of wackadoo. Every email I've been getting, the commentaries all have to do with what is driving bond yields higher and the long laundry list of things.
Yeah, Neil Dudd is saying maybe, it's not necessarily the Trump trade, but maybe it's like some of the strong economic news that we continue to have.
Yeah, I think that is a big driver of it here. And I think wackadoo is sort of normal. We haven't gotten the latest move numbers here for volatility for the day. But based on yesterday here, you're seeing a huge spike as we head into that election. 7 days away and just a few minutes away from some big earnings, with the Dow Jones Industrial Average lower by about 150 points, or roughly 0.4%. The S&P higher by about 0.2%. The NASDAQ Composite up about 0.8%, 18,712 and change. That is a record high. The NASDAQ 100 coming just within 0.5% of a record high, while the Russell 2000 is going to close out the day in the red, down 0.3%.
All right, guys, already have some earnings from Caesars crossing the Bloomberg terminal. Let's get to it. Third quarter loss, 4 cents a share. Same store net revenue, $2.87 billion. That's a miss. Street looking for $2.93 billion. Third quarter net revenue, $2.9 billion. And third quarter same store adjusted EBITDA, let's go to that number, $1 billion versus an estimate of $1 billion. Interesting, the stock not doing anything right now in the aftermarket.
The company's CEO touting the record third quarter hotel, food and beverage, and banquet revenues driven by strong occupancy and cash ADRs. Regional segment operating results were negatively impacted by new competition, construction disruption, and difficult comparisons versus the prior year.
All right. It's certainly interesting, especially construction disruption. I mean, that's kind of a constant thing, isn't it? Let's get to just what happened in the day that ended in terms of trading, because as we wait for Alphabet results, it's notable that the two sectors are represented in the NASDAQ composite did very well. Communication services and tech each gaining more than 1%. Everything else was in the red, with utilities down 2% and energy stocks off by 1.4%.
All right, everybody. Let's get to some of the individual gainers, if we may. And I mentioned that so one thing I've just been watching throughout the day ahead of Alphabet's earnings is Alphabet. And you do see that one gaining about 1.8% here in today's session. So we'll have their results shortly. The stock, we've been writing about it, not really going anywhere for months, trailing some of the Mag 7 peers. There's a bunch of risks overhang. So we'll see how much clarity we get on that a little bit later on.
All right, we're going to keep the earnings going here. First Solar results crossing the wire right now. On the bottom line, EPS $2.91 a share. That is a miss. The street was looking for $3.12 a share. I'm going to get you right to the operating income, $322 million. And net sales in the quarter also missing here, coming in at about $900 million. The street was looking for $1.1 billion. The share is slightly lower here in the after-hours trade as Alphabet now crosses the wire.
Yeah, third quarter EPS $2.12. Analysts were looking for $1.84. YouTube ad revenue was $8.92 billion, better than expected. Google Cloud revenue $11.35 billion, much better than expected. That was anticipated to be $10.8 billion. And revenue also beating analyst estimates overall, with the ad revenue at $65.8 billion. Analysts were looking for $65.5 billion. Carol, as you mentioned, this is a stock that had not gone really anywhere for the last couple of weeks. And since the last earnings, it's down about 8%. So a lot of people saying it was a fairly low bar for earnings. And this beat here shows that the stock is moving up about 5% right now.
Yeah, absolutely. I agree. Low bar. Expectations were low. Alphabet third quarter revenue ex-tax, $74.55 billion. The estimate was $72.88 billion. So you're talking about almost $2 billion more. EPS $2.12 a share. Estimate was $1.84. Operating margin 32%. That too is a beat. The estimate was 31.4%. CapEx, we're going to want to know where they are spending that AI spend. $13.06 billion, guys, and that is above the estimate of $12.88 billion.
Sundar Pichai saying the momentum across the company is extraordinary. Our commitment to innovation as well as our long-term focus and investment in AI are paying off with consumers and partners benefiting from our AI tools. Talking about how AI features expand what people can do in search. AI solutions expand what people can do in cloud. And then when it comes to YouTube's total ads and subscription revenues, touting the fact that it surpassed $50 billion over the past 4 quarters for the first time.
Yeah, and just taking a look at the expenses, because of course a lot of people are looking at sort of how you get these AI dreams without completely blowing the bank. Relatively in line with estimates here, and of course standing by that CapEx spend longer term here. At least I think some people would find that an encouraging signal.
Yeah, I mean, listen, we've talked about, right, the importance of all of these big tech companies that are reporting this week, Alphabet included, get to Microsoft, get to Amazon, get to Meta, right? They have been so crucial in terms of the NVIDIA AI spend. We've talked about that here. And so the clarity or any kind of color that we get on that is really important to get an idea of this AI trade. Is it overdone? What are the expectations? What does it mean for NVIDIA when it reports later next month? So this is interesting, but I should go back and something you said, Scarlett, is that this whole idea that the bar was low for Alphabet, a lot of overhang, and it hasn't been doing as well as some of its peers. So, beats to the upside. Investors are going to like that.
I just going through these numbers one more time. It was a beat when it came to advertising revenue, $65.85 billion. YouTube ads revenue coming in above estimates. Google Cloud revenue coming in above estimates at $11.35 billion. Services revenue coming in above estimates at $76.5 billion. Shares higher by 2.8%.
All right, and I'm just going to jump in here with one more earnings report. Mondelez is reporting third quarter adjusted EPS of 63 cents. That headline number is 63 cents. Adjusted, it was 99 cents, beating analyst estimates. Gross margin for the period was 40.5%, much better than what was anticipated. Net revenue, $9.2 billion, also topping analyst estimates. That stock moving up about 2% in after-hours trading as it sees full-year organic net revenue at the high end of 3 to 5%.
Let's go back to the tech space here. Qorvo, of course, which makes a lot of semiconductor components, out with their results here. A beat on the bottom line and a beat on the top line. But the shares, if you take a look now, down more than 14% here in the after hours trade. The company not providing guidance here, so not quite clear why we're seeing that knee-jerk reaction. But overall, we're still talking about top line growth and results that beat estimates on the top and the bottom line. We're going to dive a little bit deeper into that and get you some answers. Tim.
Okay, Qorvo shares down 14.4%, as you mentioned. I'm taking a look at DaVita Healthcare. Shares down 1.5%. The company coming in with third quarter adjusted earnings per share that fell short of analyst estimates at $2.59. Third quarter total revenue, though, the top line, it did beat there at $3.26 billion. Estimates were for $3.24 billion. Shares down right now by 2.7%.
All right, guys, we've got Electronic Arts also crossing the Bloomberg terminal. Taking a look at the forward-looking quarter, the company sees third quarter EPS 85 cents. That looks like a big loss. or 85 cents to $1.02 a share. I'm just looking for the comp here. It also sees third quarter net bookings 2.4 to 2.55 billion. The estimate on the street is 2.49 billion. Sees fiscal year operating cash flow of 2.08 billion to 2.28 billion. And we've got the estimate 2.12. Right now we've got that stock unchanged, Scarlett, in the after hours.
All right. We're also taking a look at Visa, which just came out with numbers, EPS, whether it's a headline number or adjusted, both beating analyst estimates, and the total Visa processed transactions, $61.5 billion. That is actually bang in line with what analysts had been looking for. Fourth quarter cross-border volumes also at constant currency up 13% in the quarter, slightly better than what analysts were looking for, which was 12.3%.
All right, let's take a quick look at NerdWallet. This is basically the personal finance company. We don't talk a whole lot about them. The top and bottom line numbers coming in slightly above estimates, $191 million in revenue, beating street estimates of $170 million. The bottom line numbers basically coming in unchanged here. The street was actually looking for a loss, so that's better than anticipated. We're also learning that the CFO, Lauren St. Clair, plans to resign as well, though she had been there for some time. She'll be leaving on March 7th. Shares higher by 6%. Tim.
Okay, speaking of shares moving higher, Reddit shares are surging up more than 15% in after-hours trading. The company coming out with fourth quarter revenue expected to be $385 million to, or fourth quarter revenue expected to be $385 million to $400 million, beating estimates of $356.2 million. Third quarter U.S. ARPU coming in at $5.88. Third quarter daily active users coming in at 48.2 million. Shares just continuing to rocket higher, up 18% as we speak.
All right, guys, and let's go back to how we started, right? The big one in the aftermarket, and that is shares of Alphabet. You got that stock up more than 3% here in the aftermarket. Some of the highlights, third quarter revenue, ex-tax, $70.55 billion. That is an easy beat. $72.88 billion was the street estimate. And third quarter Google Cloud revenue, also a big beat, $11.35 billion versus the estimate of $10.79 billion. So again, that stock up 3.4% here in the aftermarket. A lot of earnings, so we're both going to continue covering on both the TV and the radio side and the YouTube side. So, guys, that is a wrap. Our cross-platform on this busy earnings Tuesday. Radio, TV, YouTube, Bloomberg Originals. We will see you again, same time, same place tomorrow for the closing bell.
Our coverage continues here on Bloomberg Television with that slew of earnings, some big movers in the after-hours trade. Corvo, First Solar, and IMAX among your biggest decliners, but amongst the biggest gainers, well, you just heard Carol talking about it. Reddit, Avonex, and of course, Alphabet. A fuller breakdown of what we learned out of Alphabet in just a second. Stick with us. This is the close on Bloomberg. Sorry, we're not going to break. I apologize. Let's bring in Bloomberg Technology co-host Caroline Hyde to talk a little bit more about what we learned out of this report. And Caroline, when we look at the numbers on the headline, I don't think anybody was anticipating any material slowdown. When you listen to the commentary, though, in the release at least, about their focus on AI and their commitment to that seemed as strong as ever.
And the capital expenditure number as strong as ever. They're still committing some $13 billion. And I think this is it. We're not going to hear in the release much about antitrust, the key concern of investors, which has been the overhang on the stock. We're not hearing much in terms of competitive threats, though, and that's why you are going to hear from Sundar Pichai this consistent belief that AI is where they have to invest, where they have to change the public opinion, because ultimately they lost the faith of an investor base that perhaps they were behind when it came to innovation in large language models. But now this is where they roar forward. You see the cloud in particular, 35% growth. That is in large part because of AI, the workload that they're going to be getting from that. We want to really break out how much they're seeing in terms of subscription upticks, how much are people paying for Gemini to be able to be licensing the large language model as well. That's going to be a future driver. But for here and now, as you say, they're beating in their core money-making machine, which is advertising revenue, $65 billion. They are not getting that much competitive threat from the likes of Perplexity, from the likes of OpenAI. Thus far, they remain resilient, but we want to understand what they do in terms of changing up the business model for the anti-competition issue that has been so looming large with the DOJ here in the US and with the EU.
But again, that's not something that they're going to share right now. It's kind of like they're making their plans.
Wait for the questions,
scenes, right? Yeah, and then they'll figure out what to do. In the meantime, they plow ahead with the plans that they had laid out, which again comes back to the cloud business and the AI offerings. In terms of spending, how much transparency are they going to offer for not just capex for this year, but next year or the year after? Is that something that investors are really pressing them on?
I think they will be. We get an exact number of $13 billion. And look, that's kind of in line with where estimates had been. 12.88 had been where many thought that the quarterly focus would be. Many expecting that the second half we will see a ramp in capital expenditure because it's bearing fruit. And thus for they do want to be making sure that they're committing to the latest GPUs, to ensuring that they're getting the supply that they need for NVIDIA and developing their own chips in-house as well.
I am curious, though, and I'm going to ask you a very loaded question, because when a lot of investors look at Alphabet through the lens of AI, and particularly when it comes to the chat GPT and the other sort of language models, they're really looking to Microsoft. They're really looking to a lot of other companies that, at least in their mind, they think are doing this better than what Alphabet is doing. There's been a lot of discussion about whether Alphabet might lose market share on its Google platform, as well as they might lose market share as well on the back end as well. Is that overblown?
Well, I think that is why you're seeing Sundar Pichai teaching and telling the market how much they're doing to change that narrative by consolidating all of their AI research individuals under DeepMind. That's where they think the prowess seems to be showing. So they have brought in those that are working on Gemini to come inside of the DeepMind unit and to be able to show that consolidation, that focus, and that product commitment. Because otherwise it was seen as a lab, but a lab that then lost in the product focus versus the likes of OpenAI. I do think this is a narrative shift rather than a reality shift. But for many, they do need to keep on showing that the money is there, that the commitment is there, and they articulate it. But you're right. Many felt that they lost versus Microsoft, versus OpenAI, versus even others that are out in the field when it came to ultimately driving revenue growth. But I think they can steal that back. For now, I think the overhang on the market and the reason that their PE ratio is so much lower than competitors is because of antitrust, because of what they have to do to their overall business model, because of the DOJ.
Yeah, all good points. And it's something that I'm sure investors will find a way to ask about on the earnings call.
They will.
Later on today. Caroline Hyde, Bloomberg Technology co-host, thank you so much.
Yeah, and we're going to have a deeper dive into that antitrust discussion a little bit later here with Bill Kovacic, who used to run the FTC. All
right, in the meantime, speaking of companies that rely on advertising, Snap had gained in the after-hours trade following Alphabet's results, but after reporting its own latest numbers, it is down in after-hours trading. Snap coming up with a fourth quarter revenue outlook that does miss analyst estimates, 1.51 billion to 1.56 billion. Analysts were looking for 1.56 billion. So as results, actually, you know what? My mistake. Snap is higher in after-hours trading. I had thought that, given the outlook, I saw that it was down, but that is incorrect. In terms of the quarter that ended, adjusted EPS was 8 cents versus the consensus estimate of 5 cents, and revenue was $1.37 billion, pretty much just a hair higher than what had been anticipated, which was $1.36 billion.
All right, let's go to Chipotle here. Comp sales in the most recent quarter up 6%. Unfortunately, the street was looking for something better. Revenue in line with estimates at 2.8 and adjusted EPS relatively in line at 27 cents a share here. The company basically standing by its full year forecast for new restaurants and also saying that it is expecting comp sales growth in the mid to high single digits for full year 2024 here. A $900 million buyback not helping matters. You see the reaction in the shares down 8%, of course, coming off of the loss of their CEO. And now numbers that, while slightly elevated, certainly not the barn buster numbers that maybe some folks wanted to see.
All right. Of course, all these stocks moving in after hours trading. Let's go back to the behemoth of them all. That is Alphabet.
Before we get to that, can we get to AMD?
Oh, yeah.
Yeah, let's break AMD. AMD shares crossing the wire right now. Their earnings coming in at $6.8 billion on the top line. That's a slight beat from 6.7 of what the street was looking for. EPS in line at 92 cents a share here. And R&D expenses relatively in line at about $1.64 billion. And the company saying that they're seeing, quote, Scarlett, insatiable demand for more compute.
I want a number tied to that.
And they see more significant growth opportunities. I'm not seeing a number for that. They do give a fourth quarter revenue forecast, and that is 7.2 to 7.8 billion. It's a range. The street on average was looking for 7.6, so the street kind of in the middle of the range that they've given.
Yeah, but the big question here for AMD is, what does it say about its 2024 sales forecast, especially on the AI chips? Does it increase that to 5 billion from the current estimate that it's given of about $4.5 billion? Fourth quarter adjusted gross margin, that is gross margin for this quarter, is about 54%, slightly lower than what analysts had been looking for, which was 54.2%. the stock moving down in after-hours trading right now.
Yeah, AMD, of course, trying to keep itself in that conversation of what's going on with the AI trade. Of course, Alphabet firmly in that conversation already.
All right, well, let's stick with Alphabet here and bring in Aaron Kessler. He is an internet analyst over at Seaport Research Partners to give us his take on what he sees. And Aaron, what numbers jumped out at you? Is it what Caroline Hyde was telling us about, which is the CapEx spending for the quarter, seen topping $12 billion and actually reported at $13 billion?
Yeah, I would say CapEx is relatively in line with our expectation. It's been fairly flat for most of 24. We'll see what the commentary is on the call in terms of 2025 CapEx spend. I think that's the big question. That'll a lot of investors are focused on that for not just for the hyperscalers, but also for the semiconductor companies, obviously. I think the big number that stood out to me was the 35% cloud growth. We were looking for about 29% growth, similar to last quarter. So that was very strong in terms of the cloud growth. We'll look to the call to see what they say in terms of the drivers for that strong growth, whether that was AI on the cloud side. That'll be a big focus. Obviously, Google's lagged AWS and Azure on the cloud side, so that'll be a big focus. And then they had good strength on both YouTube as well as core search growth. That was both slightly above our expectation, so continued momentum there. And we'll look to see on the call as well in terms of momentum, in terms of AI with Gemini, et cetera.
I am curious on the YouTube front, really on the ad front writ large, the numbers slightly above street estimates here. How much growth is left in that? I saw they were touting in the release the idea that they've reached 50 billion in ad sales on that platform, at least on a 4 quarter basis.
Yeah, so we're going to have to look for the growth rates there. Just on the ad side alone, they grew about 12%. We think that growth is higher if you include the subscriptions. But we would still look for kind of double-digit growth on the YouTube side, probably a little bit above that if you include subscriptions as well. So we think it can probably grow mid-teens, including subscriptions, but not a number they disclose very often.
What are you thinking in terms of margins? Is there going to be margin degradation? We were talking earlier with Mandeep Singh of Bloomberg, and he was saying that that's going to be the biggest concern here, that even as Alphabet is able to continue to grow its revenues, the margin is going to be at question.
Yeah, we think it's a question, especially on the cloud side for a lot of the hyperscalers in terms of the CapEx spend. That is going to obviously hit the depreciation line increasingly throughout the next several quarters here. So not just for Google, but we think that'll be a concern, and maybe why we do see a little bit of a pause in some of the CapEx spending towards the end of 25 and going into 26 as the hyperscalers wait to see more revenue adoption on some of these AI initiatives.
So when we talk about the spend on the AI initiatives, you're comfortable right now with the CapEx spend, and I mean comfortable kind of overlaid with the idea of when we actually see returns, a return on that investment.
Correct. So even if you don't see all the AI revenues come in, let's say in 2025, I think a lot of the hyperscalers have said we'll be able to use that capacity, whether it's 2025, 26. At some point, we do expect to slow down that CapEx spend, but they fully expect to be able to use a lot of this CapEx over the next couple of years.
Aaron, what do you want to hear from the company that they probably won't address, but if they even get close to it, what would you want to know about?
Yeah, I mean, definitely on the antitrust side, I think that's been the biggest overhang on the shares over the last few months here. We do think probably an investor's view that the ad tech assets are most at risk of that potentially having to get spun out. In our view, there's less risk in terms of a core breakup of Google. We don't think anything's going to be really said today on the call around that. And we don't think anything's going to be decided over the next couple of years as well. And that'll be in the appeals process for a while. And then on the other hand, I would say AI is going to be the other big topic just in terms of traction, both on the enterprise side, whether that was a driver of cloud growth, as well as the consumer side, whether consumers are starting to use Gemini more for everyday searches.
All right. Great stuff, Aaron. I really appreciate you taking time to jump on this right in the heat of things. Aaron Kessler, we'll let him get back to work, internet analyst over at Seaport Research Partners. A deeper dive into the earnings that we just got out of Alphabet. Of course, a lot of people will be tuning in to that conference call in just a few minutes, not just to hear about their AI dreams, but to really hear about what they have to say about all of the antitrust scrutiny against the tech giant. It's already ramped up in Europe. It's ramping up here in the U.S. A fight is afoot, but maybe there is some settlement on the horizon. William Kovacic is joining us right now. He's the former chair of the FTC and global competition professor of law and policy at George Washington Law School. All right, I do want to kind of start off with where we are right now here in the U.S. with the DOJ case against Google, and the idea of whether we could see a resolution to this sometime soon, or is this going to drag out even longer?
The current timetable is that toward the end of November, the Department of Justice is going to issue a specific description of its remedial intentions. They've offered a general framework so far, but now they're going to lay out a plan that sets out in much more detail what they want Judge Mehta, the district judge, to put in place. Judge Mehta is going to hold hearings sometime in the spring, March or April, on the remedial proposal, probably a couple of weeks in hearings. And he said that he expects to issue his own opinion on the remedies phase of the case no later than August of 2025. So that's a relatively long road ahead just to get to the end of the trial phase. And an appeal, I suspect, is inevitable after that.
There's been a lot of discussion, a lot of reporting by Bloomberg, citing people familiar with this situation, that a meaningful breakup of this company is on the table. And I think one quote that really stuck out at me that one of our reporters got from another antitrust lawyer was this idea here that the government wants to make sure that this isn't just about punishing Google for what it did in the past, but to make sure that it doesn't re-entrench itself in those same ways, similar to what we saw with Microsoft and a couple other behemoths that went through the same process.
I think we can expect DOJ in this fuller statement of its intentions to lay out a menu for the judge to consider, a menu that runs from basically a declaration that says cut out the bad behavior to more powerful solutions that would include divestitures. The big question is what specific item on that menu will Judge Mehta find to be necessary and attractive? My own intuition is that based on his work so far, he's a very measured judge. His opinion was very careful. He's one of the most thoughtful members of the federal bench. My intuition is that he is likely to do something that goes beyond simply saying stop the improper acts. But my guess is he will probably stop short of the bigger solution, which would involve divestitures. So it will be some combination of conduct-oriented controls, perhaps some mandate that parties get access to Google's data pool. But I suspect the bigger solution that has been discussed, the breakup, is a less likely outcome in the case.
Why is that? Why is a breakup less likely?
The evidence that he presented, a couple of things. One is that he starts his opinion by acknowledging the contributions that the company has made to the development of the information services sector. And he says several flattering things about the company. One thing that brings to mind for me is that there would be some anxiety about doing things that would break that model. That is to degrade the capability of the company to deliver those results. At the same time, he did find that the company had overreached. But the basis on which they overreached has to be linked to an effect on their position in the marketplace, to draw a connection between those bad acts and observable results in the marketplace. That's a harder part of the opinion. That's a part of the opinion that might be subject to challenge. And because that is a more difficult part of the case, that would tend to nudge the judge in the direction of being somewhat more cautious on the remedy, as opposed to having a finding of fact that shows that the company had deliberately, consistently, flagrantly violated the law and done so in an obviously destructive way. It's that latter category of conduct that usually sets the foundation for a big divestiture type solution. Okay. I'm not sure that you will find in this instance that kind of case is present.
Thank you for explaining that. So here's the thing. Now that the judge has found that Google illegally monopolized the search market, the search business has also changed with Alphabet incorporating AI into it. How does this ruling and how does the procedure that's taking place right now hold back or contribute to Google's continued investment in its search business? Does it?
Well, one thing you mentioned before in your interview with Aaron is that Google is facing not only the challenge in the United States. By one academic's count, there are 150 major investigations or lawsuits across the globe dealing with Google. There's the Digital Markets Act implementation in Europe. There is a collection of matters, a downpour of matters involving Google. One has to think that at least to some extent that does limit their ability to move decisively in the development of the new technology, in deciding what investments to make. All of these are encumbering circumstances that I think inevitably limit to some extent their freedom to jump into this area as actively as they would otherwise.
I see. So leaving the door open for others to perhaps come in and do more. William Kovacic, Kovacic, thank you so much. William is the former FTC chair and global competition professor of law and policy at George Washington Law School. And of course, this is something that the company probably won't say a whole lot about. And when they do, it'll have to be, a lot of legal disclosures.
Yeah, they'll dodge this,
very lawyered language.
Yeah, but I mean, at the end of the day, though, this is going to have a big implication for the company going forward because there is a lot of interconnectivity in how they run their business.
Oh, yeah.
I don't understand how a breakup even works because, I mean, seriously, I'm not even trying to be funny. Like, it gets to this idea of how does a Google function or Alphabet function if well, at least what we've reported turns out to be true. And I think we had the same sort of discussion 20, 30 years ago with some other companies that went through this. I think Google Alphabet's a little bit different.
Well, we talk about how much it's spending on CapEx and on AI chips, but maybe it's going to be spending a lot more on legal fees as well going forward.
You know what I always say, Scarlet Fu? The lawyers always win.
All right, coming up, we're sticking with tech. Matt Bryson of Wedbush and Andrew Graham of Jackson Square Capital join us to dive deeper into AMD's results. That stock down in after-hours trading. We're looking at shares of Advanced Micro Devices. They're declining right now in after-hours trading after the chip maker gave a forecast that fell somewhat short of what analysts had anticipated, saying it sees revenue will be roughly $7.5 billion in the fourth quarter. Analysts were looking for, on average, just over $7.5 billion, $7.55 billion. Here now to discuss what this all means is Matt Bryson of Wedbush Securities. Matt has an outperform rating on the stock. Matt, are investors, how high is the bar here for AMD, given that this is a slight miss on the outlook, yet the stock is being punished right now?
Yeah, no, there's certainly a high bar for AMD. Having said that, I think a lot of the devil is going to be in the details here. So if that revenue miss is tied to console gaming, for instance, and that's how they explain it, I think they'll get a pass, and that they'll do relatively well. If they're not able to bump up the bar for their AI revenues, that would be a different story, and I think people will take that more harshly when they give commentary.
What should we be looking to? I mean, is this about kind of that PC cycle? Is there a longer-term AI story? I mean, what's kind of the big driver here that we could kind of focus on to measure their progress?
Yeah, I think it's really all about AI in the data center. Yeah. So you've got such a huge market there now, particularly given what NVIDIA is reporting, that if they're able to show more traction there, it creates a whole lot of upside to revenue going forward. If that doesn't show up, that would be disappointing.
So AMD no longer owns its own plants. It basically outsources production to TSMC. How much does that really put it in a position where it doesn't have a lot of control over its production capabilities? I mean, it's really at the mercy of TSMC's capabilities.
I mean, you could say that, but you would have to say the same thing about NVIDIA, Broadcom, Marvell. At this point, TSM is the leader in advanced semiconductor production, and if you go in the other direction, so you own your own stuff, potentially your Intel, where that actually becomes something of an albatross because you're not keeping up with TSM.
Is there a sense when we start to talk about the catch-up and the idea that NVIDIA has sort of dominated this space, both in terms of sales, but also just the headspace of a lot of investors here, Matt? Is there, I guess, a way that maybe we can see a little bit more articulation out of AMD to investors specifically about why we should take them more seriously as not just a number two, but as a closer number two, not the distant number two they are right now?
Yeah, so I mean, the thing to think about with AMD being distant from NVIDIA, so they have an order of magnitude lower sales, or more than order of magnitude lower sales, is that the next closest competitor to them is an order of magnitude beneath them. And I think AMD has a compelling argument in that with NVIDIA, they are putting more and more of their content into servers, so there's less and less differentiation for their customers. AMD is more open, and so that's attractive. And I think they can make an argument that their solutions are attractive to that large customer base, and they can compete.
All right, Matt, we're going to let you go get back to work here. Matt Bryson, Wedbush Securities, a closer look at the numbers out of AMD. You see the share reaction there. Let's get some insights out of an investor. Andrew Graham, managing partner at Jackson Square Capital, joining us right now to talk a little bit more, I guess, about this arms race that we continue to see in this space, an arms race. And if you were just listening to what Matt had to say here, that maybe AMD can play a little bit of a catch up here. But I mean, how long is this going to take, Matt? Andrew, excuse me. Sorry.
That's okay. Thanks, Romaine. I think it could take a long time, an insurmountable long time, especially when it comes to the training phase of the AI build out. So NVIDIA has a big edge in software. And so I think customers have been tier one cloud service providers have been hesitant to adopt AMD GPUs because of what they deem to be inferior software. NVIDIA's CUDA library has over 300 industry-specific accelerator algorithms already. And so that's a lot of industries, and you can not necessarily plug and play, but it does create a very wide moat, clearly, to us anyway, in this in the current phase. Inferencing phase, there might be a chance, but that's still on the come.
Well, I'm glad you used that word moat, because that really does what this looks like right now for NVIDIA. I mean, this is probably, I'm sure CEOs across every industry right now are just envious right now of what Jensen Huang has built and kind of the position he's in. That's not going to last forever, but it could last for quite a while. From an investor's perspective, though, we all can't just be piling into NVIDIA, right? I mean, there's got to be something else out there that is going to offer some potential promise for return in this AI space.
Yeah, I think it gets exciting, intriguing, and when you get further and deeper into inferencing. Inferencing is like estimated to be 1,000 times larger market than the training phase. And if you think about it, a human being, how much time do you spend learning versus doing? And you spend much more time doing. So that's sort of where so this is a much bigger business. And on the October 10th event that AMD held, they rolled out their MI325X processor, which they thought would be up to speed with NVIDIA's H200 in terms of training, but exceed it up to 1.4 times in inferencing. So that's kind of exciting. I think that's probably what drove a little bit of an uptick in sentiment coming into this earnings report. And we'll get clarity, hopefully, on the call in another half an hour or so. But look, I think you go back to the disruption, and that's what we're all looking for. You go back to the early internet days and when everybody ran Oracle on Sun Micro. You remember that? I remember it. And that went on for about 5 years, and then it suddenly ended. And you look at other companies that have faster chips and inferencing than NVIDIA does, and you start to think, I might want to pay more attention to this as we go forward.
You got to give Andrew points for the Sun Micro reference. I forgot about that.
I like
but
that.
He's dead right.
Old school. Thank you, Andrew. Given that AMD is, the sole number 2 rival to NVIDIA, but as you said, orders of magnitude behind. Is there any way where it can get to a point where it's actually competitive with NVIDIA, or has that ship sailed long ago?
I think in the training phase, I think the ship has, for the most part, sailed. They have a high single-digit share of that business, which is good. Considering how many other things they've got going on. I think AMD's advantage in the core CPU processor business is fairly evident. They've taken share there, so that's the standard stuff that runs in data centers or ran in data centers until AI made landfall. But they also, by the way, unveiled a new CPU processor called the Turin, which I think is going to help them sustain share gains. So that's a good business. It's just not as good as the GPU accelerator business, which is growing much faster.
So when we talk about this revenue forecast missing the average analyst estimate, $7.5 billion versus $7.5 billion that was anticipated, what do we know about Lisa Su and her management team? Are they likely to play it safe and be conservative when offering guidance, given that they're in this position of trying to play catch up and everyone knows that they won't be able to get to where NVIDIA is?
Yeah, Lisa's got a great reputation. She deserves it. Management is executing flawlessly. They're doing a great job. It's just a very difficult ask to get there. I think that they plan to spend money and continue to, come at the castle head on. I'm not sure it's going to be successful, but they're going to spend some money doing it. So that might affect or impact gross margins, as they spend more on OpEx, particularly R&D. I'd love to see it happen. I think a lot of people, a lot of investors would like to see it happen too, but it is a difficult task ahead. And so I think they'll be able to, if they're going to do anything, it's going to be in the inferencing phase. And I think there's a lot of other entrants that can come into that inferencing phase. And NVIDIA, which we own and love here at Jackson Square Capital, they just, they say that, look, no one's going to want to replace all this equipment that they put in for the training phase to run inferencing, but it's entirely possible that optimizations are worthy, or it's worth changing out some equipment, and in which case AMD's got a chance there, and I think some other names as well, 3 of which are private that I think are up-and-comers.
All right, good stuff. Andrew, really appreciate your joining us. Andrew Graham is managing partner at Jackson Square Capital, and they do own shares of AMD. Let's take a look at some of the other movers in after-hours trading following their results. There's a trio of names here on the board, and they're all gaining right now in after-hours trading. Visa, among them, gaining just over 1%, stronger payments volume, beating analyst estimates. Snap also getting a lift after Alphabet. It's climbing after a third quarter revenue and adjusted EPS beat analyst estimates. And Reddit, the clear winner here of the bunch, at one point surging 22%, its fourth quarter outlook topping analyst estimates.
All right, this is a close on Bloomberg.
All right, we've been flooded with a wave of earnings. We told you about AMD, about Alphabet. Let's get you a roundup of some of the other big notable movers with Jess Menton. And Jess, you've been looking at Chipotle, which is down in after-hours trading. I can't imagine that this is just due to the Brian Niccol effect, his leaving.
No, it wasn't. And even to that point, because now this will be the first earnings call with their current interim CEO. So that'll be what people want to hear about the executive kind of shakeup here. But even despite that, the stock was already up over 30% year to date. But really what it has to do with, there's been a high bar. And especially when you think about Chipotle compared to some of its rivals in the casual dining type space, it's been able to mitigate more of some of the cost pressures in some of its rivals. But analysts on the sell side were saying that could potentially be a soft spot. So that was something that came up. But UBS was actually looking at, there was sort of supposed to be like a smoked brisket that they were hoping would have better sales than expected in the previous quarter. But that was something that analysts were keeping a close eye on. But the bar, nonetheless, was a little bit too high for this company.
Smoked brisket, that seems like a little bit more effort than it's worth. This could potentially be another type of turnaround story. Not a huge turnaround, but obviously a company that's going to have to kind of find its footing with some issues it was dealing with prior to Niccol leaving, and of course now with him gone. Another company that's also dealing with its own issues is Cheesecake Factory. They just reported earnings. They were actually good. I mean, it was better than expected here. But as you know, there are a lot of people looking at this company saying it could be even more efficient.
Right. And in recent quarters, it has had a better streak of beating those expectations. But actually, there is some interest in potentially breaking up the company. So the Wall Street Journal actually had a story recently where they were talking about how JCP Investment Management was thinking that if they break up the company, as well as because they actually own other segments.
Into the food versus the cheesecake?
So there's actually other segments beyond just the cheesecake type factory that we all kind of know and love. So there's North Italian. That's actually a casual dining concept, not surprisingly, about Italian food. Then there's Flower Child. It's actually a health-focused fast casual chain. And then Culinary Dropout. It's a gastropub known for more of kind of like pretzel bites and things like that. But it's going to be important to see, do they have any indication about potentially any sort of comments about the activist investors and what they're trying to push there?
This is the JCP's whole thing, right? But isn't the footprint of those secondary locations so small? Like, is that what's really dragging on the company, on the stock?
So in some types of segments on like a margin type basis, it is. But I think it's a little bit kind of a conundrum because you do think of it more as the name brand type of restaurant that I'm sure we've all gone to. I've gone to many of them in Texas.
All right. Can we talk about Reddit?
Yes.
It's a big mover here in after hours trade. And I think this surprised a lot of folks.
Right.
A lot of people saying this stock should have never even been public. And yet it's defying a lot of expectations.
It's up almost 22% 22% here in after hours trading. So this is its first time it's actually turned a profit since we went public in March. So that was where people were watching really closely. Also, that stock's up about 140% through today's close on that. So really you saw a profit, and then also revenue being third quarter sales and earnings estimates. And then also if you're thinking about what it could mean for moving forward, especially with daily active users when it comes to social media companies, it actually came in around 97 million active users from that quarter. That was actually up from about 66 million. So that actually did slightly below the consensus estimates, but still kind of close in line there. And it also issued better than expected revenue forecast for the current quarter. So that's why you're seeing a big pop there, especially turning a profit.
Yeah, and the narrative on Reddit is also that it can license its data to train AI models. And there's a lot of data there that they can throw at the models, right?
No, it is. And that's another big thing as far as the AI story. I mean, we're already seeing, say, Snap. I mean, that was a company y'all mentioned earlier. I mean, that's down about 6% in after hours trading, but that has to do with kind of like with the ad business and what that means for if you're looking at Alphabet or even Meta, which obviously will have those earnings coming up later.
And it makes
this
you
week.
kind of wonder, like, do we even have a dominant social media site? I mean, I know in the numbers, I mean, it's still Facebook, but I mean, dominant
I do know some people who don't go on some of the traditional kind of social media sites, and they only are going on Reddit now because they're kind of tired of getting on some of these other platforms.
Yeah, I know a couple of people like that as well. I know some people who don't go on them at all. Jess Menton, but you can't do that. How can you live? Bloomberg's Jess Menton here, a closer breakdown here of some of the earnings that we got in the after hours trade. Chipotle down about 4.5% in the after hours trade. Cheesecake Factory up, and Reddit, your best performer, at least among mid to large cap names. We're going to set you up for some of the potential market moving events occurring over the next 24 hours. Stick with us. This is The Close on Bloomberg.
The expectation today is that Donald Trump will win the White House in just a few days. We'll know shortly. And big picture, the reduction in uncertainty is almost always positive for asset prices. And we're at that moment of peak uncertainty. It is a race that Trump is favored to win, but it's almost a coin toss.
Ken Griffin, the CEO of Citadel, speaking at a conference over in Saudi Arabia, that Future Investment Initiative Summit, making his case as to why he thinks folks expect Donald Trump to win the election on November 5th here in the U.S. Isaac Boltansky, Director of Policy Research at BTIG, joining us right now. If you listen to Ken Griffin, if you look at some of the prediction market data, it all seems to be pointing to a Trump victory. The polls themselves may be a little bit more undecided. Isaac, what's your outlook?
Sure. Look, I think we've all had to pick our own mental models for how this election is going to go. And the polls have been a bit messy, and there's good reason to cast doubt about their accuracy. The prediction markets have moved a fair amount pretty dramatically, but I don't know if we can have enough confidence in them, at least this round. I think over time they're going to be more helpful. What I've decided to do is look at state level data, Romaine, and I've looked at what animates the voters there and what they say is going to push them to decide who they're voting for. And time again, in the 7 states that are going to decide this, they've said that the economy and immigration are the number 1 and number 2 issues. And they favor Trump by 5 and 14 points respectively on those 2 issues. And so for me, I'm telling clients that I view Trump as a very slight favorite to win this election based on that mental model.
I am curious, and we'll get back to some of those policy issues in a second, but I am curious with regards to the polling data. We go back to some of the missteps that a lot of that polling data had, not only in the last election, but more importantly, in the Trump victory against Clinton back in 2016. The idea that at the state level, Isaac, a lot of those polls showed Clinton beating Trump in those states. We saw something similar with Biden. And then when the actual results came in, it was a huge flip-flop from what the polls suggested. Are we going to see a repeat of that?
Massive mistakes 2 different times, which is why I think all of us should have caution. Now, look, I spend a lot of time talking to pollsters, so our clients don't have to. And what you hear from them is, we fixed it. You know, if you look at the midterms, we've been able to address some of the issues. Plus, they're really focusing on voters who have previously voted, and they're hoping that that will help them get a better read for things. But look, I'm not going to believe it until I see it, and even then, I'm going to check it twice. And on this one, I can tell you, I still personally believe there is a shy Trump voter, Romaine, and that's one of the reasons that I, in addition to my main one, that I view Trump as a slight favorite. How I can be wrong, which I think about a fair amount, is I do wonder if these pollsters, in attempting to focus more on these voters who have voted previously, are missing out on perhaps young voters who didn't vote in previous cycles, or others who are finally being brought to the table because of Harris policies. We're not going to know until after Election Day.
Well, there's a matter of answering the questions on what they care about and then actually making their way to the polling sites and voting. And that's a whole different story, young people in particular. What's your read on early voting and how that's shaking out? There's been a lot made about how typically Democrats come out more in early voting, but this time around we're seeing a lot more activity on the Republican side.
Yeah, I think that we all just need something to talk about for the next few days. I'm not reading too much into it. In fact, I've generally framed this to clients as this early voting data, to me, it allows us all to live this, choose your own adventure storyline. You can pick out specific voting data from the suburbs of Georgia or from Arizona to paint your own picture. I don't think any of that is super helpful for us. I've instead tried to focus on things that, that I think we can have real confidence around. For example, I have real confidence the Senate is going to flip to Republican control. Those are things that I've had more traction with clients over the past few days.
So very quickly here, I mean, we're all anticipating, bracing for some kind of legal challenge. Under what situation would there not be any kind of legal challenge? How much of a lopsided electoral count would we need to get for there not to be something like that?
Look, I'm personally of the view that we're going to know who won the White House within 2 or 3 days of the election. And maybe that's a bit counter, but look, I think there are 3 reasons why. Number one is there aren't going to be as many absentee ballots this time as there were during the pandemic. Number 2, there have been some state level changes that should expedite the processing. And number 3, the conventional wisdom in D.C. is that it's going to take weeks upon weeks. And I think it's generally fair to fade conventional wisdom in D.C. So, look, I think we're going to know in just a few days after the election who the winner was.
All right. Isaac Boltansky, Director of Policy Research over at BTIG. 7 days until the election day here in the U.S. as we push ahead to some of the potential market moving events over the next 24 hours. That includes some big earnings tomorrow morning out of Caterpillar, Hess, Kraft Heinz, and Eli Lilly.
And Eli Lilly, of course, has been a superstar with its weight loss drugs. But Caterpillar will be super interesting. It's another industrial company. And, of course, it has its own chief economist giving forecasts for not just the U.S. economy, but the global economy.
I think after the bell here, we are going to get some potential real market movers here. And, of course, that includes 2 heavyweights, Microsoft and Meta.
Yeah, and it's all about the AI spend, the CapEx there, and especially how they're doing for Meta on the advertising business and in the cloud business for Microsoft.
Hey, eBay. I actually used eBay for the first time the other day.
What did you get?
It's a gift, so I can't say on air. But
okay.
Yeah, it was hard to find, but I found it on eBay.
Good for you.
But there you go. Anyway, all right, we're also going to get that Treasury Department quarterly refunding announcement tomorrow morning. But more importantly, we're going to get that first read on GDP for the third quarter.
Absolutely. And this is something a couple of our guests have pointed to as, kind of setting the tone as we head into the jobs report. PCE is also coming out, another read on inflation and pending home sales as well.
Yeah, and this could be, I think, pretty consequential in people's view of the economy. Obviously backward looking, but still gives us a shape here of what was. We'll be back tomorrow. Balance of Power is up next, right here on Bloomberg.